Have you ever thought about what is the cost of a missed opportunity or a lost client? I know we're almost halfway through the year and we're all looking at how many loans have I closed so far? Am I on track to hitting my goals? But we often lose sight of the cost of the missed opportunity. So I want you to think about and dollarize with me, what is your average loan amount and your average commission, let's say? And how many people do you have in your pipeline from just the start of the year that you know are pre-approved and could be out shopping, but have probably already purchased, or maybe you found out when it was at a lull in your business that by the time you finally reached back out and nurtured them a little bit, they had already bought with another lender. So think about how many closings you've had, how many apps of those apps, how many were actually pre-approved? How many could still be out looking, or maybe they chose to rent, but how many did you lose and you didn't even know it? Or how many clients in your database have you helped buy or refinance before that they may have refinanced last year, or maybe they're looking to buy again and they didn't use you? If you really start to dollarize the cost of a lost customer, it's a huge chunk of our business. And I really feel like it's probably the most expensive part of your business. So I had a lot of you mention that you really enjoyed last week's coaching session where we read the first chapter about the dentist example and how when you can really create a phenomenal client experience, you can create almost your own little non-paid salesperson who's your raving fan out there in the market. So this week, it's going to be the same process. If you guys are driving home, if you're going on a walk, know that you do not have to be looking at the camera and watching for this coaching episode. This is purely just audio. So take a big deep breath or focus on the road if you're driving. And I'll read this chapter, but I'm going to sprinkle in just a few of my Deb nuggets and how I would apply it to the mortgage industry. So let's go. It's chapter 3, the cost of losing a customer. How much time do you spend whining, dining, and courting prospective customers? And when you think of customers, I want you to think we have two types of customers. You have your end user or your borrowers customers, and then you have your referral partners, whether that's real estate agents, CPAs, whomever. But I want you to think there's two different client experiences or journeys of just creating the lead, nurturing the lead, converting the lead, and then retaining the lead, whether that's, again, a borrower or a referral source. So I'm going to read this opening again. How much time do you spend whining, dining, and courting prospective customers? How much money do you spend trying to acquire new customers for your business? How many people in your company focus on marketing and sales? Now, let me ask a much more important question. How much time, money, and energy do you spend trying to keep your customers? Nearly every business spends a huge amount of time, money, and energy trying to land new clients. Customer acquisition is usually the highest single cost center in a business, and many executives can detail their customer acquisition costs down to the dollar, if not the penny. And yet, in almost all of these businesses, where so much effort is spent trying to persuade people to become customers, virtually no effort is spent trying to keep the customers once they have them. So, what happens? Customers leave. Most businesses are hemorrhaging customers and don't even realize it. I first became aware of the customer retention epidemic that plagues almost every industry in the late 1990s. While reading a report about how banks market and advertise to gain new customers, I learned something startling. Historically, banks spend a significant sum of money on acquiring new customers, which is approximately about $300 per account. Now, this $300 per account is justified as making economic sense because the relationship between a consumer and a bank was supposed to follow these two things. The customer opens a bank account, and the account remains open for a long time. The longer an individual or business stayed with the bank, the more fees were paid for banking services. The more customers the bank acquired, the more money the bank would make. In reading the Corporate Executive Board report called New Customer Onboarding Programs in Service Industries, I discovered a dirty little secret about the world of banking that diminished the acquisition strategy employed by banks. 32% of new customers who join a bank will leave that bank before their 1-year anniversary. 32%. I was shocked. Consider the basic math. On average, it costs $300 to acquire a banking customer. That customer pays a monthly account maintenance fee of $12 a month. Looking only to the guaranteed income from maintenance fees, it takes 25 months, that's more than 2 years, before the bank earns back the initial investment in acquiring that customer. So if 32% leave before reaching the 12-month mark, that means the bank has the potential to lose money on 32% of its newly acquired customers, which raises the urgent question of why are customers leaving at such great personal cost? While the financial cost to the bank is staggering at scale, the personal inconvenience to customers who go through the enrollment process and then decide to leave is even worse. Think back to the last time you opened a new bank account. Let's be honest, it's a pain in the neck. To open the typical bank account, you go into a local bank branch, you present your government issued ID, fill out reams of paperwork, and make an initial deposit to fund the account. After that, you order checks, request an ATM card, set an ATM code, and re-enroll for online bill paying and direct deposit. You then wait while things continue to process in your old bank account, which many people keep both the new and old bank accounts open for several months of overlap before finally shutting down the old bank account and transferring any remaining money into the new account. It is mind-boggling that a customer would ever leave after going through all of these steps and investing this much time, effort, and patience, and literally 32% do just that. In fact, 20% of the customers who leave in the first year do so without having conducted a single transaction, not one ATM withdrawal, not one check clearing, and not one payment of an online bill. A shocking 50% of customers who leave in the first year quit doing business with the bank in the first 100 days. What are you guys doing? So this is a stop and pause moment. What do you do strategically with intention in the first 100 days post-closing? Are any of you hosting home appreciation parties? Are you intentionally calling to see how was the move? Do they need any recommendations of contractors? Any contact at all in the first 100 days? Just think about that. And it doesn't count if you're only reaching out to get a Google review, okay? The relationship has barely started. The customer may not have ever closed their prior bank account, and yet they are already leaving. This revelation about banks losing customers left me with one burning question. If customer defection is an epidemic in the world of banking, where paying close attention to the bottom line, the cost of acquisition and the rate of retention is part of banker DNA, what must it be like in other industries? I started researching all kinds of businesses and marketplaces around the world, and what I found was staggering. Despite the fact that cell phone contracts are notoriously horrible and require you to give up your firstborn child to break them, 21% of cell phone customers break their contract within the first 100 days. While no one likes it when their car breaks down, even fewer people like their car repair experience. I want y'all to think back to your last car repair experience. This is a good one. Between 60 and 70% of car owners go to an auto repair shop once and will never visit that shop again because the first experience was so bad. Restaurants live or die based on their ability to keep customers in the seats. And yet 46% of new customers at Chuck E. Cheese's pizza restaurant will never visit a Chuck E. Cheese's again after their initial visit. Is it really fair to blame Chuck E. Cheese, or is it all the kids running around and the noise and the whatnot? Possible germs. Anyways, after half of the new customers the restaurant worked so hard to acquire appear to dislike the experience so much that they never return. This defection turns into a downpour in the ever-expanding software as a service cloud industry. 20% of newly acquired customers don't make the 100-day anniversary mark before leaving. The combination of internet, phone, and cable television services offered by integrated telecom providers sees staggering rates of customer defection in the first 100 days. We're all seeing a pattern with what typically happens in the first 100 days. While most companies are unwilling to share these rates publicly, defection rates of greater than 30% during these first few months are not uncommon. Regardless of where your business operates, what industry you work in, or the size of operation, you are likely losing approximately 20 to 70% of your newly acquired customers in the first 100 days of their relationship. So let's think about even just the leads that you get. How many leads do you get that you lose? According to this, it's between 20 to 70% just in the first 100 days of the relationship. Now apply that to your real estate partners or other referral sources. Companies spend an incredible amount of time, energy, and money to obtain new customers, but are hemorrhaging customers after the sale. So why don't businesses focus on retaining the customers that they worked so hard to earn? Think about that. How many applications do you have to get to finally get one that qualifies? How many qualified apps do you have to go through to finally get an executed contract that wins in this market? And then how many of those have to then pass inspection and meet appraisal and finally make it to the finish line? That why would you stop there? A lot of loan officers tell me that they tell clients their job really starts the first day after closing. But I want you to really assess your process and get really real. And how true is that? And then how can you apply that into your social strategy? How can you show bite-sized pieces of that in your stories when right now we're seeing a huge increase in story surfers? Are you posting 4 to 5 times on your story, making the first story an engagement post where you're using a sticker to maybe ask a question? Because anytime you start to build a little bit of interaction with your story in the beginning, it really helps for what we've seen more and more story surfers. And what I love about posting to stories is you really need to show the human side of you, the behind the scenes, the day to day. That's like the reality TV show. There's not really a content strategy. It's you just being you and a human, and what I call human to human marketing, not B2B, not B2C, but sharing like pain points where you're building more connections, lead to more conversations, and more conversations lead to more conversions. So if you're wondering why your social media is not growing to where you want it to be, I challenge you. Are you posting at least 4 to 5 times on your story, spreading them out? Are you making your own comments and own story comments and own likes? Like I would say the goal would be 45 comments a day, where you're proactively outreaching in your prospect time on key accounts where you're replying to stories or you're proactively leaving that comment. Again, you can set a 15-minute timer. I know because we do this for our influencer clients. We will comment on their behalf. We will help build relationships. What we can't be is you. So don't forget to still be the human so that you're building those connections, because people fall in love with brands the same way that they fall in love with people. And that means you have to put yourself out there. Okay. So why you lose customers? While there are a number of specific reasons why you may lose a customer, when viewed more holistically, they boil down to a single fact. You lose customers because they feel neglected after the sale is made. Think back to the last time you quit doing business with someone. You may have said it was the price, but in reality, you could have paid for it. You may have said you were going in a different direction when you didn't really need to do that. You may have said you weren't getting value anymore, but really you still were. You may have just stopped doing business with them without saying why, and your decision was affirmed when the company didn't seem to care that you were leaving. The typical business does a great job of getting the attention of the customer and persuading them to buy, but then does very little to create a meaningful and remarkable experience for them after the sale. There are many reasons why customers leave, but the main reason is that businesses systematically ignore the emotional journey of the customer. It's not that they don't care. It's that the way that they do business and the way that their incentives and structures are set up creates a blind spot around customer experience. And that blind spot is the very problem. Emotions and experience are an afterthought. Over the years, companies have evolved into larger enterprises with more moving parts, more people, more rules, and more regulations. Humanity has slowly but surely been removed from the majority of interactions and discussions. In the modern business, one often hears phrases like, it's not personal, it's business. And work is work, and personal is personal, and the two aren't meant to mix. There's a strong belief that personal relationships, conversations about feelings, and displays of emotion should be kept at home, out of the business arena. As businesses have grown colder and more structured around policy without taking into consideration the people the policies impact and affect, consumers increasingly feel uncared for and not considered. Customers no longer feel special because more and more of the operations and structures are designed to keep the personal out of the business. Think about that when people are filling out that initial loan application. It's like, goodness, can you date me before you ask me for my social security number right off the bat? We haven't even had a conversation. And I'm supposed to trust you with my whole life story, filling out a loan app as my very first interaction with you. Just think about that. Re-listen to that chapter from last week where we gave the example from the dentist and how they made that person from the moment he even walked into the dentist office for the very first time. The director of first impressions knew exactly who he was and referenced him by name. In most organizations, new customer onboarding and experience is not consciously designed, logically structured, or consistently executed in a way that meaningfully contributes to the customer's emotional journey. I want y'all to think about when you're doing your video series, and I always try to pick a theme for the month. So in June, it was student loan was the theme. For July, it's going to be more centered around relocation as the theme. What is the real pain point of why people buy homes? What's the emotional state? Maybe they just lost their job and they had to get a new one, and the new job happened to be in Texas. And so they're relocating, or maybe they're getting divorced, or maybe they're expecting their first child. Like, what is the real pain point that felt need before the want? Because they want the home, they want to buy a home. Are they tired of not being able to customize their rental home or their apartment, or they're tired of living with mom and dad? Like, what is that emotional need that's driving the want? And that's how you create a value series for your marketing, so that you're showing up and even tagging certain locations or hashtagging certain keywords that's going after the emotional state. The closer you can get to that mind state, the better. For example, it is assumed that the customer read the fine print in the proposal contract and know what comes next in the process, even though the people making these assumptions don't usually read the contracts or proposals they themselves are asked to sign. This failure to be on the same page causes problems when the fine print comes back to harm the customer later in the relationship. Has anyone sent a pre-approval letter out with a certain interest rate and maybe didn't highlight or explain the fact that the interest rate wasn't locked? Therefore, it could change by the time you win and execute a contract. And maybe you have felt this pain point from the relationship with your client, that rates increased when they went to lock in rates now that they have a home. Imagine that panic and that feeling of what kind of experience that makes the customer from their lens, whatever they feel is true to them. And that's what creates the customer experience. It may not be what's real, but it's real to them. And they may feel like you just bait and switch them by offering this really low interest rate that they weren't ever going to be able to get. So remember, they don't do this from day to day. They may not know how interest rates move and how much they've been moving and how it wasn't even locked in the first place. And although it was in the fine print, maybe they didn't read it. These situations arise when an individual rents a car, enrolls with a cell phone provider, selects a healthcare insurance plan, etc., only to find out that the customer's understanding at the time of purchase doesn't align with the way the company handles things when conflicts arise. Customers are surprised to learn that they are responsible for the cost of repairing common door dings on a rental car. Customers are infuriated to learn about the huge financial penalties for switching to another mobile phone service provider before the end of the contract term. Customers are crushed to learn that a necessary health procedure isn't covered by their insurance. Finally, the steps in the new customer process are done in an order and sequence that aligns with the company's operations, with little care or concern for the customer's experience or needs. Most customer experience is haphazard at best, with no clear roadmap or milestone for the customer or the company to follow. Brain science and fundamental human behavior are ignored. Brain science teaches that even if a prospect knows, loves, and believes in a company's offerings, after they become a customer, fear, doubt, and uncertainty will plague their thoughts. Having the customer's brain stacked against the company from the onset, combined with the lack of guidance from the organization at this point in the customer's life cycle, puts the customers into a state of heightened negative emotions. This state is exhiberated by the stark difference between the new customer's feelings of fear doubt and uncertainty, and the company's joy, euphoria, and excitement about acquiring a new customer. Okay, this is the last paragraph. So those of you who have hung with me this far, don't worry, we're almost done. So to put a bow on this, it says they're leaving faster than you know. Current business trends glamorize growth, incentivize acquisition, fail to consider the emotional journey of the customer, undervalue retention, and underpay and underequip customer-facing employees. Not to mention the fact that they completely ignore their customers' basic biology and human behavior. It's no surprise that customers are leaving so quickly after they sign up. But how can you stop the hemorrhaging? You need to focus on what your new customers experience when they start working with you. So homework assignment this week, I want you to map out from your customer's eyes, not what you think your client's experience is, but what is that journey and how can you stand out from the competition? Because there's always going to be someone out there who has a lower interest rate, who may be able to get it faster, who maybe has another loan product than you do. But your brand is built on how people talk about you after the process. And that could mean after they're first introduced to you, after they first apply, or after they close. And again, that's your end user or your referral partners. So I want you to think about that while dollarizing and going back and looking at those pipelines for any missed opportunity. Who could we reconnect with? Who could we re-engage with so we can get loans now and gain market share? Y'all take care. That sums up this week's coaching call. If y'all have any questions, any feedback, please let me know, and y'all have a great week.